Hi, I'm Tom Lydon, editor of ETF Trends, here in Hollywood, Florida at the Inside ETF conference. And I'm here with Eric Ervin, who's founder and CEO of RealityShares. Great seeing you, Eric.
Yeah, thanks for having me.
So a lot going on here at the conference. One of the big topics is fixed income. And most importantly, different strategies so you can still maintain income in potentially a rising rate environment.
Yeah, I think that's the biggest challenge that everyone's been searching for, this alternative to fixed income, knowing that rates could someday rise, but not knowing when they're going to rise. And they just kept stretching and stretching and adding risk to their portfolio. Well, the end of last year was kind of the first awakening of that. As interest rates started to rise, some of those alternatives didn't really offer an alternative. They were just other bonds.
So they were tested and they, in some cases, failed.
Yeah.
So it really put a thought and concern in the advisors' heads as we go into 2017, where, hey, inflation appears that it might continue to kick in. Trump's got this growth plan in place. And if the Fed pulls the trigger again, we're really going to have to be more concerned, right?
Yeah, and I think the biggest thing is to think about bonds as we've always thought about them, as risk reducers and not return enhancers. Now everything's kind of flipped, where bonds are really that risk enhancer and not really if anything, a return reducer. So if you look for alternatives, you need to do it in a place where you're really looking for things that aren't necessarily yield oriented, but just stability and conservative type of an approach there.
So let's talk about one of your ETFs, Divvy, D-I-V-Y. And tell us a little bit about that strategy.
Yeah, so I started my career at Morgan Stanley 15 years ago when interest rates were 5-6%, and bonds really did offer that stability and that risk reducer portfolio. But as rates came all the way down to near zero, I really wanted to find an alternative, and that's where the institutional market had been doing, investing in this market called dividend swaps, where they capture the growth rate of dividends on the S&P without any of the interest rate volatility, none of the correlation that you might find otherwise. And that's where I just knew this was the perfect product for an ETF. So we launched the fund 2 years ago, and it's now a full 2 years of history, and it's almost the single best performing from a Sharpe ratio of near 8% returns with a 3% standard deviation over the last year, which is fantastic.
Well, from an alternative standpoint, it's a great area for people to look, but it takes education and also almost a little change of mindset, because normally people wouldn't think, yeah, that's really a dividend structure, a yield play, but in most cases they wouldn't qualify it as that.
No, exactly. And that, again, that's why you almost have to think it's an alternative, it's an absolute return strategy. And yes, it invests in the dividend marketplace, but it's not designed to create dividends. It's really designed for stability and returns and non-correlated type of an approach.
Yeah.
With that, it's like a zero correlation to the ag. So it really does offer that diversifier where a lot of funds don't.
And we talk about it, we've done webcasts, and the outpouring of interest is crazy because people just didn't know it existed, right?
Yeah, that's our biggest problem, is it's kind of that best kept secret. Now that we do have that track record and we do have the history and we have been doing some of these educational outreach approaches, we're seeing asset flows like crazy. They're coming into the fund. And I think also with the new political environment, if you think about any kind of corporate tax reduction means more cash is going to come back to shareholders, and that's where we thrive, is when dividends rise, we perform. And that's exactly the market where we're looking at right now.
You've also got some great dividend growth strategies. If people want to learn more, they can go to your website, correct?
Yeah, at realityshares.com. And that's, if you think about RealityShares, why is it reality? It's because dividends are real. You can't fake dividends. We focus on dividend growth and future dividend growth, and more particularly. So that's what we're all about. We live and eat and breathe dividends.
You can't fake dividends. You need to make t-shirts.
That's right. Yep.
Excellent. Great seeing you.
All right.
Thank you.
Thanks for having me.